Welcome again, dear students and scholars. The three videos so far gave us the foundation, the rules, and the worked examples for ASC 270. Now we test that learning. This practice video has 8 multiple choice questions, 4 short answers, and 2 long answers. The goal is not to memorize lines. The goal is to recognize the interim reporting logic, apply the correct rule, and avoid the traps that usually cost marks. We will move from quick checks to structured scenario answers. For each multiple choice question, lock your answer first. Then listen to why the correct answer is right and why the other options fail. For short answers, focus on scoring points, not long essays. For long answers, organize the facts, show the calculation clearly, and connect the conclusion to ASC 270. Use the same 4-step method throughout this practice set. First, identify the interim period and the reporting date. Second, start with the annual US GAAP rule. Third, check whether ASC 270 modifies the timing, allocation, estimate, deferral, or disclosure. Fourth, decide whether the item is recorded, deferred, allocated, disclosed, restated, or reclassified. This method will keep your answers disciplined even when the fact pattern becomes crowded. MCQ 1 tests the main philosophy of ASC 270. The question asks how each interim period is generally viewed. Think about whether a quarter stands alone like a separate fiscal year or whether it is part of the full annual reporting period. This choice drives estimates, allocations, and year-to-date true-ups. Lock your answer before reviewing the explanation. The correct answer is B. An interim period is viewed as an integral part of the annual period. Option A describes the discrete view, which is not the primary ASC 270 model. Option C is too narrow because interim reporting is not only about taxes. Option D is also wrong because ASC 270 is not merely optional internal management reporting. The memory anchor is simple. A quarter is part of the annual story. MCQ 2 tests revenue cutoff. A product is shipped on March 30th, control transfers on April 2nd, and the quarter ends on March 31st. The key fact is not the shipment date by itself. The key fact is when control transfers under the revenue guidance. Lock your answer based on the reporting date and the transfer of control date. The correct answer is C. Do not recognize Q1 revenue. Control transfers after the quarter end date, so revenue belongs in Q2. Option A is wrong because shipment alone is not always the revenue trigger. Option B is wrong because there is no basis to split one performance obligation across the reporting date. Option D is wrong because expected collection does not override the timing of control transfer. Interim cutoff is as serious as year-end cutoff. MCQ3 tests inventory estimation. The question asks which statement is correct when a physical inventory count is not practical at an interim date. Think about the gross profit method, the need for practical reporting, and the disclosure that must accompany estimation. Lock your answer before moving to the answer slide. The correct answer is A. The gross profit method may be used for interim periods with disclosure of the method. Option B is wrong because a physical count is not mandatory at every interim date. Option C is wrong because ASC 270 permits estimation methods when appropriate. Option D is wrong because disclosure is required. The point is not careless approximation. The point is reasonable estimation with transparency. MCQ number 4 tests temporary LIFO liquidation. An entity liquidates a LIFO base layer during Q2 but expects to replace it by year-end. The issue is whether the old low-cost layer should create an artificial interim profit. Think through the annual period logic before locking your answer. The correct answer is D. Include the expected replacement cost effect in interim cost of sales. Option A is wrong because permanent recognition of the low cost benefit would overstate Q2 profit when replacement is expected. Option B is wrong because ASC 270 does not defer all cost of sales until year end. Option C is wrong because the liquidation cannot be ignored. The memory anchor is that temporary layer loss should not create temporary profit. MCQ 5 tests the inventory recovery cap. A $50,000 inventory loss is recognized in Q3 and the same inventory recovers by $70,000 in Q4. The question is not whether recovery is allowed at all. The question is how much recovery is allowed. Lock your answer by applying the prior loss cap. The correct answer is B, $50,000. The Q4 recovery is capped at the loss previously recognized in Q3. Option A is wrong because recognizing the full $70,000 would create a net gain above the prior loss. Option C is wrong because $20,000 is the excess recovery that cannot be recognized. Option D is wrong because recovery is allowed but only up to the earlier recognized loss. Recovery cap equals prior recognized loss, nothing more. MCQ 6 tests contingency settlement allocation. AQ4 litigation settlement becomes reasonably estimable and relates directly to sales in Q1, Q2, Q3, and Q4 of the same fiscal year. The key phrase is directly relates. The answer should follow the periods connected to the underlying activity, not the date when the settlement became estimable. The correct answer is C. Restate prior interim periods for their directly related portions. Option A is wrong because putting everything in Q4 ignores the connection to earlier current year interim periods. Option B is wrong because equal spreading is arbitrary unless the facts support equal allocation. Option D is wrong because a material estimable contingency cannot simply wait for annual financial statements. Direct relationship drives allocation. MCQ 7 tests a change in accounting estimate. New information in Q3 causes an entity to revise its warranty estimate. The phrase new information is important. This is not a change in accounting principle and not necessarily an error. Lock your answer using ASC 250 logic applied in an interim reporting context. The correct answer is D. Account for the estimate change currently and prospectively. Option A is wrong because prior year restatement applies to error corrections, not normal estimate revisions. Option B is wrong because Q1 and Q2 are not automatically restated when the original estimate was reasonable based on the information available then. Option C is wrong because the entity should not wait until year end. A new estimate receives forward treatment only. MCQA tests public interim reporting. For a public reporting entity, the question asks, what is generally correct about quarterly SEC reporting? Think about Form 10Q, condensed unaudited interim financial statements, and the difference between quarterly and annual reporting. Lock your answer before the reveal. The correct answer is A. Condensed unaudited interim financial statements are filed on Form 10Q. Option B is wrong because a complete annual style report is not required every quarter. Option C is wrong because quarterly reporting is mandatory for most SEC registrants. Option D is wrong because ASC 270 does not eliminate SEC interim disclosure requirements. The public reporting layer is condensed, unaudited, and mandatory. Short answer 1 asks you to explain the difference between the integral view and the discrete view of interim reporting. Build your answer around the reporting period logic. For the integral view, think about how a quarter connects to the full year. For the discrete view, think about what happens when each quarter is treated independently. Take a moment to form a concise 3-point answer. A strong answer should say that the integral view treats each interim period as part of the annual reporting period. It permits estimates, allocations, and true-ups based on expected annual results. The discrete view treats each interim period as self-contained, so transactions are recognized only in the period they occur. ASC 270 generally prefers the integral view, although it uses discrete style treatment for items such as unusual or infrequent events that belong in the period of occurrence. Short answer 2 asks how an entity may estimate inventory when a physical count is not practical. Structure your answer around 3 ideas: the method, the disclosure, and the limits. Do not answer only by naming the gross profit method. The examiner wants to know whether you understand why estimation is permitted and what controls apply to it. The model answer has 4 scoring points. First, the gross profit method or another reasonable method may be used when a physical count is not practical. Second, the method used must be disclosed, including significant adjustments later identified. Third, estimation does not override loss recognition under the inventory measurement rules. Fourth, the annual physical count or later actual data should true up the interim estimate. Estimation is allowed, but it is not a hiding place for losses or weak measurement. Short answer 3 asks about seasonality and material unusual or infrequent items. These two concepts must be separated. Seasonality is a recurring business pattern such as holiday sales or agricultural cycles. Unusual or infrequent items are specific events. Build both sides of your answer before reviewing the model. For seasonality, the answer should say that entities disclose the seasonal nature of operations so users do not misread interim results. 12-month data ending at the interim date may also help users understand the trend. But seasonality does not justify artificial smoothing. For unusual or infrequent items, the item is reported in the interim period in which it occurs and is not allocated across the remaining quarters. The exam trap is mixing disclosure for seasonal patterns with recognition of special one-time events. Short answer 4 asks you to differentiate a change in accounting principle from a change in accounting estimate. The main scoring contrast is direction. A principal change usually looks backward when retrospective application is required. An estimate change goes current and forward. Take a moment to build both lanes of your answer. For a principal change, the model answer expects retrospective treatment when required, including restatement of previously issued interim periods of the same fiscal year and relevant disclosure. The change must be justified under ASC 250. For an estimate change, the effect is recognized in the period of change and prospectively. Prior periods are not restated unless the original estimate was actually an error. The key trap is treating every revised estimate as an error correction. Long answer 1 gives the Aster tool scenario. You need to handle three tasks: compute Q1 estimated cost of goods sold and ending inventory, explain the Q2 true up when the physical count becomes available, and explain the temporary LIFO liquidation treatment. Before looking at the model, separate the gross profit calculation from the LIFO issue. They are related, but they are not the same scoring point. The Q1 gross profit estimate starts with $5 million of sales and an expected gross profit rate of 40%. So the cost ratio is 60%. Q1 cost of goods sold is $3 million. Ending inventory is beginning inventory plus purchases of $4,200,000 minus cost of goods sold of $3 million, giving $1,200,000. For Q2, first half actual cost of goods sold is $6,300,000. After subtracting Q1 cost of goods sold of $3 million, Q2 cost of goods sold before other adjustments is $3,300,000. The temporary LIFO benefit of $90,000 should not inflate Q1 profit because replacement is expected by year end. So the expected replacement cost effect is included in interim cost of sales. Long answer 2 gives the BrightPeak retail group scenario. It combines advertising, customer rebates, flood loss, and litigation settlement allocation. Each fact uses a different ASC 270 logic. Advertising tests future period benefit. The rebate tests annual volume effects. The flood loss tests period of occurrence reporting. The litigation settlement tests direct relationship to interim periods. Build the answer around timing and allocation. For advertising, the $120,000 paid in Q1 benefits Q2 through Q4. So it is deferred in Q1 and expensed at $40,000 per quarter as the campaign runs. For the rebate, Q1 eligible sales are $800,000 and the expected rebate rate is 5%. So the Q1 rebate accrual is $40,000. The rebate reduces Q1 net revenue and is reassessed as later quarter sales develop. For the flood loss, the $200,000 unusual loss occurred in Q3, so it is reported in Q3 and separately disclosed. It is not spread across the year. For litigation, current year settlement amounts are assigned to the directly related interim periods. Prior current year interim periods are restated for their portions. The current quarter records its own portion, and the prior year portion is allocated to the first interim period of the current fiscal year as a restated amount. The allocation follows the activity that caused the settlement, not an equal split. You have now practiced the major ASC 270 areas: the integral approach, revenue cutoff, inventory estimation, LIFO, recovery caps, expense allocation, contingencies, changes, public reporting, and scenario analysis. This was a practice video, so the goal was not speed, the goal was reasoning. If this helped you, please like the video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel. In video 5, we will cover a quick ASC 270 revision map and a comparison with IFRS IAS 34.